Hello and welcome to the Oury Clark Audio Quick Guide, a straightforward conversation about a range of topics and issues commonly handled by Oury Clark experts for their clients. My name's Dominic Frisby, and joining me on today's episode are two gentlemen who both share the same titles. They are chartered accountants, chartered tax advisors, and partners at Oury Clark. They are Andy Oury and Jeremy Coker. And today's hot topic is EIS, Enterprise Investment Scheme. So, Jeremy, why don't you kick us off? What is an enterprise investment scheme?
Thank you. Well, the Enterprise Investment Scheme is a scheme which is designed by the government to help smaller, high-risk trading companies to raise finance. It offers a range of tax reliefs to a number of investors who are going to purchase new shares in those companies.
Yeah, it's great, to be honest. I mean, it's bonkers that in this country, if you can, as an investor, get 30% of your money back, which is, that's quite impressive, really. Plus, there's a whole other release, isn't it? You don't pay tax if you hold it. Yeah, it's a really, really generous relief that really encourages investment. And venture capital companies can use it. It's called VCT. It's very similar. And it drives our venture capital market, being the largest outside of the US and China.
And are there certain rules that a company needs to observe?
There are quite a few rules that need to be observed. I think investors need to be aware that the company has to observe certain rules, not just at the time of investment, but for 3 years after. And if the company fails to meet the rules, then the investors could lose various very, very advantageous tax reliefs that Andy was talking about over there.
Okay, so it would be no fault of the investor, it would be the fault of the company not following protocols.
It could be either the investor's fault or the company's fault, because the reliefs are so generous, as in the rules are very, very strict. So for all intents and purposes, if you want to go down this route, make sure you have competent chartered tax advisors, chartered accountants, and lawyers who know what they're doing.
But to scare people a little less, unless you're doing something like digging for oil, investing in shares, buying property, if you're doing anything that the rest of us would consider as a good risky venture, a startup in technology or all these sorts of things, and provided that company isn't too old, roughly speaking, less than 7 years, but it's a bit more subtle than that. So it's not too old, it's fairly new, and it's doing something which isn't like buying property or something that really no one needs to encourage investment into, then there's a high likelihood you qualify for it. But as Jerry mentions, you've just got to be mindful of the fact that you have to stay within these rules, is that you can't take the money and then decide you will buy a bit of property. That would scupper the plan.
So if you break the rules, what happens?
Well, the company has a duty to inform an investor if it believes that it is going to do something which will make it ineligible. I don't believe the investor can stop them unless it had enough shareholding power. But they lose their tax relief. So the primary tax relief is, as an individual, I get a third back. There is a more generous version, I think we may talk about, for much smaller amounts of investment that gives you up to a half back. But, I go to invest some money, I put £50,000 in it, and I'm going to get a third of that back in my tax return, provided I'm paying sufficient tax. That's very generous. Then if I hold the shares for 3 years, I will not pay tax when I sell those shares. No capital gain. So it's capital gains tax free. I can invest in a company. I can invest £100 in a company and it only costs me £70. And then in 3 years' time, when I sell my shares, even if they're worth $1 million, or if I sell my shares in 10 years' time, provided it's at least 3 years, I pay no capital gains tax. Incredibly encouraging. Then the third layer is you can take any gain, any type of gain from anything, anytime you have made money selling an asset of some kind, and you can roll that gain into your investment. So you could go and sell your property for, sell your third house for £1 million, and normally you'd have a huge tax bill, and you could say, well, bugger that, I'm going to take all the proceeds and I'm going to stick it in this risky company, and then I'm going to get tax relief back, and I'm not going to pay capital gains tax, and then in 3 years' time, I won't pay tax on the sale, although you could release the original gain. Anyway, you get complicated. But they are so generous, these rules.
So let's say, I'll give you an example. My mother has a flat which she bought in South Kensington in, I'm going to say 1984. So, and I think she bought it for like £30,000 or so, an extraordinarily low sum. And it must be worth, I don't know, $1.5 million or something now, something like that. And so, if she were to sell it, there's an extraordinary capital gains tax to pay. And the rent that it yields doesn't justify the current value of the property. If she was to sell that and then roll it straight away into some kind of EIS venture,
she would delay the gain. You delay it. Technically, if you put it into the very high, so there's a scheme called SEIS, CDIS, which is for up to 150,000. But she would delay the gain, and yes, so therefore delay is as good as the truth, or good as not paying tax. And she provided she was paying sufficient tax. She invested £1 million, say and in that year or in her previous year, or both combined, she had paid £300,000 worth of tax. The government's going to give her £300,000 back. A very important rule of EIS is to get the tax relief. You can't usually invest in your own company. It's called connected. You can't have more than 30% of the shares or your friends and family. As usual with tax, if you're thinking, oh yeah, but I've got this clever idea. It's like, no, they've thought of that. So, you can't start a company and say, oh, I'll invest my own money and get a third back in cash. Doesn't that sound wonderful? No, you can't do that. But that doesn't apply to deferral relief. Deferral relief, you can invest in your own company. So I can make £1 million that I'm going to pay tax on and say, bugger that, new limited company called Dominic Hilarious Comedy Ventures Limited, invest the whole lot into that, and I delay my gain until I sell that company or otherwise. And that is a really commonly misunderstood or missed concept, that you can roll the gain under EIS.
I don't know why people don't do that with all their capital gains.
It's a lot of money, £1 million.
Yes.
You have to
risk, in other words.
Yes, you have to invest in a risky venture. That's step one. As in, essentially, it is supposed to be high risk, like I said, ab initio, because there has to be a risk to capital. You can't just put in a company where there's no risk of losing money. And essentially, if you do that, then you won't get the relief. The revenue will not allow you that relief. So that's the issue. But as long as you invest in the right kind of company, then all the reliefs are available to you, or if it is your company, then at least a deferral relief is available to you. The one thing that is also helpful is, even if you invest in your risky venture and it all goes to pot, you will be able to claim that loss against your income, assuming you have enough income. So you can set off a capital loss against your income. So a capital loss on an EIS investment can actually be set off against your income.
So the next sort of paragraph is why should I care, which I think we've covered. We care because EIS makes it easy for a company to attract investment. It enables those investments to raise more money, and it can make investors very happy. But it's not just a matter of looking at it from the perspective of the investor, but it's looking at it from the perspective of the business owner. So how will it help my business?
Many ways, actually, as in, basically, if you think about all the investments, as in what the benefits the investor gets, say the investor is going to invest £1 million, he knows it's going to cost him £700,000 because he's going to get income tax relief. And so where a company has shares that it values at £1 million, the investor is not going to be unhappy to pay £1 million for those shares, which means a canny investor can say, well, those shares are 1.1 million. The investor still may not care, because he thinks that at the end of the day, his investment is protected. The truth of the matter is, it is a risky investment, but most investors in EIS kind of companies are generally risk takers. And because they are investing in entrepreneurial kinds of businesses, it's a good thing for them. So essentially, the investor or the company can raise a bit more money to finance any ventures that it wants to do. And that is a really, really good thing.
I think getting people to invest is bloody tricky. And so you add together all of the benefits of EIS, particularly deferral relief, and that person with plenty of money in the bank who should really be investing in the economy but isn't. It gives enough of an incentive. Their accountant is sitting there saying, we could roll this gain, we get 30% back. It's enough to push people over the edge to say, all right, bugger it, I'll put the money into the company, And, sometimes tax is a good thing. I mean, Dominic, you talk about this, but, sometimes taxes can be used for good in terms of changing behavior. And I think this is something we should really be proud of. It really changes behavior, that you can really say to that person who's sitting on their 100 million quid, come on already. I'm the accountant sitting advising him saying, you may as well, Yeah,
the accountants always take the prudent route normally, don't they?
Normally.
So the accountants say,
yeah, nudging you.
But this is a very good idea that actually should help stimulate the economy, because instead of putting your money in static investments, as in it enables you to support people who are ready to take the risks. And the kind of profile of the investor is the kind of guy who made it very early, sold his business and is just sitting on oodles of cash so he can finance people like himself, as in little hims.
The flip of the coin is that the venture capital trusts use it. So there's basically an almost identical scheme called VCT, venture capital trusts, and venture capital companies are generally set up as trusts, and we don't need to explain that, but eventually there's a load of individuals who come together to invest. The downside is that if you are not EIS eligible or VCT eligible, the amount of venture capitalists or indeed investors who are going to be interested in investing in you is dramatically reduced, like by 90%. So the unfortunate thing is that there are some areas of industry you might be doing something very positive or very important, but the nature of your business is not eligible.
Yeah, that's unfortunate. So how difficult is it to do?
As long as the company meets the criteria, then it is easy.
What businesses can I not do it in?
It's like oil, property, land,
Accountancy, legal.
professional services. That's right. Trading, stocks and shares, certain forms of sort of trading. Anything where you're buying underlying value. You've got to be creating value rather than saying, well, I'm buying a property that's worth $1 million quid.
Just flipping value.
Flipping value.
I got you.
When you say it's easy, there's something called assurance. So you go to the revenue, say, here's all my situations. Can you give me a certificate to say I can do it? It's not actually required. To get EIS investment, it is easy as this. You offer someone to invest in your company and you've checked that you aren't doing something ineligible and your business is young enough. They put the money in your bank account. You issue them the shares. That is basically EIS investment. Then what happens is you effectively send off for a certificate, a couple 2-page form saying, I've had an investment. Can I have a certificate? They send you back a certificate. That's it. I mean, people think they have to register anything. Amazingly, you could do this in the same day if you wanted. You could give me cash today, Dominic, into a limited company. I can give you the shares and it's done. What you tend to do is go for advanced assurance because some annoying accountant or somewhere along the line is going to say, oh, well, if they got assurance, I'd like to see the assurance, no matter how obvious this company is that it qualifies. So you go for assurance, you write to the revenue, you wait a month, and they say to you, yeah, fine, we think you're eligible.
The truth is the investor themselves can also ask the question as in, have you actually obtained EIS advance assurance? Because they don't know you from Joe Blogs. They just know that I can do an EIS investment. So in order to actually attract that investor, when you say, I've got this sheet of paper saying I've gone to the revenue to say my company qualifies for EIS.
If it's an English company doing something abroad, can it still qualify?
The key qualification, and very good question, is the top company in the group. The companies can be anywhere in the world, but the top company, the company that is invested in at the top must be a British company or must be an overseas company with a formal permanent establishment. That basically means a proper substantive activity in the UK of that foreign entity in the UK, and you need to register the company as what's colloquially known as a branch, technically known as a UK establishment. So the top company doesn't even need to be British, but it needs to have an activity of a substantive nature in the UK.
So the next question is when to do it?
As soon as possible, really, because it is, ab initio, when the investment started, as in there wasn't any real age requirement for the business. And so because it's such a good thing, most people piled into it. And then the revenue thought, no, it's not really being targeted at like new investment. They want new investment. And so we have effectively a 7-year limit. Essentially, if you think about it, then as in anybody with any company would say, oh, guys, I need some more money to finance, I might as well go for one of these venture capital schemes. So they introduced a time limit such that you can only qualify for EIS if effectively your first sale has been within 7 years. And it's a very, very funny rule, as in even if you're a new company today and you haven't made a first sale, if you were to buy a business that made a first sale more than 7 years ago, you sort of jeopardized your relief, so it is pernickety, but you have effectively a 7-year limit, and once you actually do it once within that 7-year limit, there's a possibility of doing it again at a later time. So essentially, first 7 years from your sale, basically.
First commercial sale, you've got 7 years to raise an EIS investment. And provided you tell the revenue that you expect to have further follow-on investment and you don't say nothing, they will allow you for the next 20 years to claim EIS investment.
And that's another good reason why you go for advance assurance, because when you go for advance assurance, you also tell the revenue that, yes, we're starting this, but in the future, we also want to do X, so that it sort of puts in your back pocket the additional time limit.
I've got you. So, and it's 7 years, but it's 10 years for knowledge companies.
Knowledge investment companies, yes.
Basically, you look at the value of the IP, how much you're spending on R&D, and you can also look at the qualifications of your staff, how many of them have masters, or if you can't qualify under the qualifications of staff, which often you can't because computer programmers half the time haven't got lots of nice degrees, sometimes they do. You can also look at the main source of your income in the future will be the exploitation of IP. But yeah, if you're panicking and thinking, oh, it's year 8, can I qualify? There is perhaps a get out of a 10-year window if you can prove your company is particularly knowledge intensive or R&D intensive.
And that's a good thing, another good thing, because as we can see, IT and technologically related like investments have actually enabled us to survive this pandemic, really. You know, so to the extent you actually tick boxes that way, as in you can actually qualify. So I think that's another good thing.
Final thing, what are the things to watch out for?
We don't like to talk about bad news, but the thing is, like I said earlier on, you need to get your advices and make sure that you're doing it right, because anything could go wrong, as in the investors could get something wrong, the company could get something wrong, and like you just don't want to do something. If I put it very simply, as in sometimes when it goes wrong, it's not the end of the world, because like I said, you have to qualify for the 3 years. But if within that 3 years a big company comes and buys you out, the investor loses his EIS relief, but does he mind? Because, you know, yes, he has some capital gains to pay, but he gets a lot of money. Do you know what I mean? So it's not as bad as it could be.
The key, though, is the 3 years, is that just because the money's in the bank and the investor's got his certificate and he's put it in his tax return and he's had his money back and he's happy and thinking, I'm good. It's the next 3 years and the activity of that company. And it can do things like buy a subsidiary doing the wrong kind of thing, decide that it's going to pivot in a direction which is in an ineligible activity, you know. So almost all companies that take EIS investment, I would say there's moments that you're like, whoa, you know, remember EIS, you know. So it does restrain, it does it forces the company to stay on the track to a great extent that it's set out to the revenue when it started.
3 years on the straight and narrow or else, you know.
But then it's party time and into property.
No employees, no directors, unless, you know, you have to meet like specific rules, and you can't get EIS if you already have shares in the company. So
EIS requires that the shares that are issued are ordinary shares, don't have any preferential treatment. So it's very important. So the company you invest in hasn't given you any preferential treatment. Now that could be they took you out for lunch a lot, they gave you some goods and services. That could make you an ineligible EIS investor. But the key one people cock up is that if the shares you have any preferential basis over the other shareholders, it's not eligible. So you think, oh, that sounds all right. Well, there's a reverse. Is what happens in a company is you have shares and then you give someone lower class shares. So, you know, the economy shares, or, you know, while everyone else has business class, you offer them shares that have less rights. When you do that, and that's probably one of the most common ways that people cock up their EIS, is that you just made the EIS shares preferential to the now degraded shares, and you lose it. So they just about allow you to have ordinary shares, so full rights, full right on wind up to capital, full right to a dividend. These are sort of classic share rights. You can remove voting rights for share options, for EMI, for instance, but that's it. So you know, it's okay there's being other classes that are better, but it is not okay to make one that is worse, so therefore you're better.
All right. I think that is the EIS well and truly covered. I'm going to read out the top 3 pieces of advice in regard to EISs. 1 is get advance assurance. 2, get someone who knows what they're doing to draft the articles. And 3, don't use EIS funds for the wrong things. And that is EIS advice from the point of view of the business rather than the investor. And gents, what's the simplest piece of advice people should remember?
I repeat, it's to make the income tax claim or else you lose available capital gains tax exemption.
You can roll a gain into your own company. EIS deferral relief is they are all separate little reliefs. So EIS deferral relief is a separate relief. So you can invest in your own company and defer gains.
And I'm going to get myself a T-shirt and it's going to say EIS on it because it's so good.
Yes.
Ladies and gentlemen, thank you very much for listening. If you want to find out more about anything we've just been talking about, you can find that information in the resource library section at ouryclark.com. Jeremy Coker, Andrew Oury, thank you very much for joining me. And if you can't find what you need, I should say, dear listener, send us an email, contact@ouryclark.com, and one of our experts will get back to you and tell you everything you need to know. Until the next episode, goodbye.